Welcome back to the HUBB U.S. Market Update, Friday, 24th of March. We welcome to the show Rob Roy, the Chief Market Strategist at Elliott Wave Options. Welcome back, Rob.
Thanks, Dux. How are you this Friday?
Fantastic. A little bit hot. It's a bit hot in here today. That's why I'm a little bit flushed. But listen, to everyone watching, Rob uses HUBB's software platform, which is charting software you will see during his analysis. And you can check that out at hubb.com, which the link is below in the description. Every Friday at 5 p.m., Rob is going to break down US markets for you, including the S&P, VIX, the Dow, Qs, interest rates, the dollar. Like, what more could you ask for? You can ask for his stocks of interest as well. And this week, he's going to be looking at Block, Coinbase, Nvidia, Apple, Amazon, Tesla, the iShares Silver ETF, which is SLV, and also discuss his thoughts on the Fed rate hike this week. We're sure that you're going to have plenty of questions for Rob, and he's going to do some Q&A for you at the end of the show. So don't be afraid to get those questions in there in the chat. You had some great ones last week, so keep those coming. Before we get started, don't forget to click on that subscribe and like button below. It all helps build the platform that HUBB is building. All right, Rob, let's jump into it today. Let's talk about the US market.
Sounds good. Here's the chart of the market, and you can see I do have the Elliott Wave label turned on, the software, and there is no 5-wave impulse pattern. The software will label the ABC corrective patterns, which are flat, zigzags, and triangles. My personal preference is to turn the automatic labeling of those off because there are tools that you can use to draw them yourself, and I just prefer that. But whatever someone's preference is, if they like to have them automated, you can do that as well. I also like to look at a clean chart here, and I think that's one of the great things about the HUBB software platform is the charts are really clean. People talk about that all the time. They're so easy to see. And I'm a visual learner. You know, everybody learns. You've been through school, you know, auditory, visual, etc. I took a IQ test and I scored 100% on the visual spatial part of it, which is identifying patterns, and that's visual looking. So I really like this. When we look at a chart of the S&P, I've been talking to our subscribers about this. There's two different ways you can look at this pattern. I think you can make an argument that we have a symmetrical triangle formation here on the SPY that is lower highs and higher lows. Or if you preferred, because we talk about that 380 level a lot as support, and it certainly has been a support and resistance area for a while, you could extend that upper trend line down on the lower highs and say that, no, we're in a descending triangle pattern. So regardless of whether you look at this from a symmetrical triangle or a descending triangle, which we could likely go and churn here a little bit longer above this, the point is that we have a corrective pattern, a triangle consolidation format in the S&P, and we are looking for some sort of a breakout. One of the things that I think may add just a touch of credence here to the symmetrical triangle, taking these lines off, is look at the doji that we finished with today. And for those of you that are not candlestick people, and I'm not the foremost candlestick expert, I fully admit that, but I am aware of some of the basic ones. And a candlestick looks, or a doji looks exactly the same, whether you're in candlesticks or bar charts. And that's where you have an opening price, and then you see the high and the low, and then the closing price is very similar to the open. That normally means indecision. A lot of people think that, oh, a doji means change of direction. Officially not. Officially, a doji means that there's indecision. Now, often when you see that, something's getting ready to happen. So the fact that we have a doji right near the point of this symmetrical triangle, which is how I prefer to draw this, I think at the beginning of next week, we're going to see something of significance occur. When we put the moving averages on, we're trading just below the 10-day moving average. The close has been right below that for several days, as you can see. Also leading into, I think, something of significance is going to occur likely next week. With the size of this triangle, the bottom part of the triangle is at 360, the upper part is at 420. That's implying a 600-point move in the S&P. That's pretty significant. So which way are we going to go? I think it's really important, especially when the fact that the Elliott Wave impulse pattern is not labeling a 5-wave pattern. But when you see these triangles, it's important to note that a triangle, when you read the works of R.N. Elliott, trumps everything, meaning that we could go either direction. Don't get caught in picking which direction you think things are going to go. Obviously, we've had a lot of negative banking sector news over the past couple of weeks that we've talked about, but you don't want to say, oh, we're definitely breaking to the downside. Maybe we are, but we could break to the upside. And the fact that there's a lot of negativity, that could be enough to say, hey, there's not all the people looking at the market breaking to the downside anymore, and we could break to the upside. So either way, we could move. And talking about interest rates, before I get into the rest of the markets, I wanted to show you this chart because this is significant. If I turn the Elliott wave pattern on, you can see that we have labeled this. If you've watched the past broadcast, there was no 5-wave impulse pattern on the TNX. That has labeled today because we broke through this level of support that the 10-year, and that's again the TNX for the 10-year, broke below that all-important 34 level. I'm a big fan. Anyone that's heard me talk before knows that I constantly talk about how you need a follow through or confirmation day when you break a major point of support, resistance, moving average, break out of a triangle, whatever. One day means nothing. There's a lot of head fakes that occur in the market to try to get people to step in, but then you want to wait and look for that confirmation day and see if this is indeed a head fake. But the fact that we closed below 34, I think is significant. Normally you would say, oh, you know, interest rates going down, that's probably pretty good for the market, especially for the Qs and the tech stocks. They like lower rates. But the fact that we've had such a vertical move down, we consolidated a bit, and breaking below here is a little concerning to me on the fact that this was a pretty vertical move coming from the lows of the 10-year back in August around 27. And if we do have a follow through day on Monday, a lower close on rates again, there's literally nothing from a support resistance standpoint stopping the 10-year from coming all the way back down here and testing these. Now, why would that be a negative? Because you're talking about, oh yeah, interest rates coming down as a positive for equities, especially tech stocks. But it also means that money is moving from the equities market into the bond market. Prices and yields move in inverse directions. And if yields are coming down, prices are going up. That money has to come from somewhere. And, you know, we look globally to see where that's coming from. But the fact that you see a significant move lower in rates, probably there's a good part of that money that's coming out of the equities market, which is not a positive for a potential upside breakout out of that triangle in the S&P. So if we take a look at the Dow, so I look at the DIA, again, no 5-wave pattern. That was in a 5-wave downward impulse pattern. That's relabeled. It's also in a corrective pattern. And we talked about this last week where we had this zigzag pattern, and look at this, right exactly to the 100% extension on that zigzag. And you can see all the sideways movements we've had since we hit that 100% level. That's how viable these Elliott wave Fibonacci patterns are. And the fact that we retrace back up to the previous fib level at 61.8 leads for the possibility, at least, that we could see a downside breakout on the DIA, an extended C wave, if you will, all the way down to the 161.8% level. So Elliott wave rules state that once you complete the zigzag to find out whether or not you're going to have an extended one, you should go back and retest the previous fib level. It's exactly what's happened. Now, I'm not saying that we're definitely moving down to the 161.8% level. You've seen the structure of the triangle on the S&P, but I'm saying it's qualified now from all Elliott wave rules that we could break below there and head lower. So enough concern on potential downward moves out of the S&P and the DIA. But when we go and look at the Qs, different story here. We're in a very solid 5-wave to the upside impulse pattern. So no impulse pattern in the Dow or the S&P, but there is in the Qs. And we've talked about this in the past, that the Qs underperformed as the Fed embarked in the rate hike campaign. And now that's coming to an end. And at some point, I think, probably not as far out as people think, we're going to see some rate cuts. That's a positive for tech stocks, and by far the best pattern of the three major indices here on the Qs moving to the upside. We look at the 10-day moving average well above the 10, 30, and 50-day moving averages. You can see we have a little bit of resistance here right at that previous wave 3 high, the 5 labeled because it broke the 3. good consolidation here. So we're consolidating right around 310. So something's got to give, right? So we have a triangle pattern in the S&P, could break either direction. The Dow is like, okay, we completed, or did we, a downward zigzag? Perhaps we have. And then the Qs are saying that, hey, we're consolidating here for a potential break higher to the upside, where that wave 5 forecast is labeled that tap box, which is a really cool feature of the software, gives you a time and price projection of when this could occur. So the move to the upside by around the 3rd of May, if all continues to play out. So they're not quite in alignment, the three major markets. So we'll see how that plays out next week. Looking at the IWM, and we did break 170. We've talked so much lately about this trading range between 170 and 190 on the small caps, the IWM, and the fact that we broke below that, but closed. We managed on the close barely by the skin of our teeth to get back above that 170 level. So holding that support, at least for now. I like the analogy of a guy holding on to an edge of a cliff with your fingernails. How long can you hold? Well, that's what's going on now on the IWM. So if you're like the small caps, if you're long the small caps, you want to see this 170 level hold and start to move back to the upside. It looked pretty constructive over the past week or so. And then you can see what happened following the Fed meeting this week, where we have broken down here and are just barely holding on to that level. So one last chart here of the VIX, hanging right in this 23 area. We broke above that, and we talked about the fact that if it were to break above there was clean air. I like the racing analogies. Always had fast cars like that kind of analogy. If you're out in front, you got clean air coming in. When you're in the middle of the pack, you got all the hot air from the exhaust of other cars. You got all the little bits coming off the tires. A little harder to generate horsepower when you're in the middle of the pack, but easier when you're out in front. Kind of works that way as far as breaking above support resistance. You're up here in this clean air, and you can see the size of these intraday moves on the VIX. It's amazing, but we are closing still right at 23. So we could go either way on the VIX, and obviously a break higher in the VIX would imply a downside breakout of that triangle. But if we can hold here at 23 and start to break down towards those lows around 18, 19, that would imply the fact that perhaps we're getting an upside breakout out of that SPY triangle, and that would be beneficial across the different markets.
Right. Now, listen, the technology you're using there, Rob, that's called TradeFinder, right?
The software is actually called Profit Source, but we use Profit Source and TradeFinder for sure.
Oh, great. And so on TradeFinder, you do some case studies using that technology, right? So when is that show?
I'm glad you brought that up, because one of the stocks of note that I wanted to talk about was Coinbase. And we did talk about this in Tuesday night's TradeFinder, because you can see what happened here. So to answer your question, it's Tuesday night at 9 p.m. Eastern time. It's free. You can sign up here with a link provided, or you can go to ewotrader.com and sign up. We look at the markets, we identify case study considerations, and we have a live Q&A at the end. And one of the viewers on Tuesday night asked about Coinbase, and perhaps you've seen it in the news. What we talked about Tuesday night was that we had this vertical move. So let's go back, and that's another cool feature of the software, is you can walk back and see that that was a vertical move. And anyone that's listened to me at all knows I'm concerned about vertical moves. What goes vertically up often comes vertically back down. And all you have to do is look back at this same symbol, Coinbase, when it went vertically up here at the beginning of February, right back down. So what happened here? The question was, is it time to go long Coinbase? And I had the exact opposite view, thinking, we're overbought. And we have this big vertical move. We're at this area of resistance here. There's a good conglomeration back in August, and the highs here in the beginning of February. And so here we are looking to break to the upside again. And I felt like, hey, let's let this go and consolidate a bit. And then bam, there's your vertical move back down, from the fact that now we've got the regulators are looking at Coinbase. And that was the negative news that occurred. And you never know what the news article is going to be, what news event's going to come out to move it. And people always ask, well, is it forecasting the news? I don't think it is. It's just somehow there's coincidences that occur. There was no doubt we were overbought. We had a vertical move, probably going to come back down. Now, if you're looking for a positive on Coinbase here, the fact that it held the 50-day moving average, that's that royal blue line, and then bounced a little bit and then touched the 10-day moving average on the high yesterday and then again today. But when you start to get the regulators involved, you got to kind of be, all right, what are we doing here? I think if we're looking at Coinbase, Dux, we should go ahead and take a look at Bitcoin as well with this move. And here's the same scenario right now, two different things. Coinbase had some negative news that came out from the fact that the regulators are looking at it. But when you had this move up here on Bitcoin, and we chatted about this last week, I believe, or the week before, of is there so much concern about our paper currency that money's moving into the digital currency, or is it because we have another one of those Bitcoin halvings? I mean, people make fun of me on the recordings of this all the time because I don't seem to pronounce that word properly. Halving, whatever it is, usually occurs, or the next one scheduled in the first quarter of 2024, and historically Bitcoin moves in front of that. Is that what's going on? Is it some concern about the banking and our paper currency? Or is it a combination of both? But nonetheless, we had a vertical move up and we're consolidating. Look how the software nailed this, Dux. Just this tap box here with the high and the low, and we've been consolidating dead sideways right in there. So if you are bullish on Bitcoin, you can take the fact that we haven't had the vertical move back down. I still think you need to keep that in the back of your mind. So I think caution is in play here. A little more sideways consolidation, allowing the 10-day moving average to catch up a little bit more. As you know, Doug's one of my favorite sayings, and no security in any time frame gets very far away from the 10-day moving average, and that applies to Bitcoin as well. So the fact that it got overbought, but it's consolidating sideways without much of a give back, I think that's a positive as we're looking at Bitcoin. Sorry, I didn't mean to get away from your question about TradeFinder and Coinbase, but I just thought if I was talking about Coinbase, I might as well add Bitcoin in there as well.
Well, you sort of jumped the fence a little bit there on me because now.
Sorry about that. I do that a lot.
Well, it's we want to get into your stocks of interest, but as we go into that now, like the US dollar is very interesting, and but how do you think rates will impact the dollar going ahead, especially after the rate hike this week?
Boy, a lot to talk about there, isn't there? Let's take a look at the dollar. And I've been a long time fan of the strong dollar, but I also talked about the fact that when we had this big run in the dollar to the upside here, that was too much. You don't want too strong of a dollar. It's just not good for international companies with exchange rates, et cetera. So that was too strong. The fact that it's coming down, I think, is very beneficial. You can see that we're in a very qualified 5-wave to the downside pattern on the dollar with the wave 4 corrective move right at the 38.2% fib level. We do have a little area of support right in here. And if the dollar holds here, we'll have to evaluate that. But if you look at this break from the downside here and moving lower in the dollar, if we are able to break 102 on the dollar and go down to this wave 5 target, which is fine with me. One of the comments I've consistently made is as long as the dollar stays above 96, that's an area where I think you have kind of the Goldilocks scenario where you have a strong dollar, not too strong. Last thing we want is for the global economies to lose faith in the dollar, right? So you don't want to see the dollar tanking, but the dollar moving down a little bit, I think, is an aid for the cues that we looked at. And also, by the way, I just wanted to note that 96 is right in the tap box. I think that's coincidental. The fact that the dollar moving down, I think, is something that we want to look at with the metals. We also looked at this in TradeFinder Tuesday night, Ducks, where you can see the GLD is moving vertically to the upside. I've been wanting to get in the metals. I've been wanting to send out an alert on GLD or SLV to our alert subscribers at ewotrader.com, but I've been a little bit concerned about this vertical move, but I do like the chart of the SLV. You mentioned the SLV. Note that there is no 5-wave impulse pattern here. It's a corrective move. And so when you see a corrective move, you want to know which one is it, a flat, a zigzag, or a triangle. We know we have the triangle pattern in the S&P. We know we just finished a zigzag in the Dow. What is it in the S&P here? And it is a zigzag pattern. Look at this, Ducks. You can see this move here, just a classic zigzag setup here on the SLV. And we are, look where that 61.8%. Yeah, you can't make this stuff up. The 61.8% extension is exactly where that consolidation occurred back in December and January. It looks like that's where we want to go in the SLV. And I think that you know, my disciplines haven't wanted to chase this yet because there it is above the 10-day moving average. So we're a little bit overbought on the SLV. I might be getting a little too picky here. I really don't want to wait until we break above the 22 level, even though there's still plenty of room from 22 to 24 if the SLV is able to break through all of this consolidation here. But the separation from where we are in the 10-day moving average just makes me a little bit nervous. I really wanted to send this out today. You can see where the opening was up here on the high, the little notch to the left. That was way overbought. We did close near the low of the day, but it was kind of a flat day on the SLV. I was hoping for a little bit more of a pullback to go ahead and send that entry alert out on the SLV, but we're waiting again. Perhaps I'm being a touch conservative, but gosh, I really want to be long here on the SLV or the GLD. I just think that the SLV is a better looking chart with that vertical move in the GLD and so close to the wave 5 target. But as you were asking about the dollar, the fact that we could break lower here in the dollar, that's the key, right? That's what makes trading so difficult. Do you step in now? An aggressive move would be saying, hey, based on that 5-wave pattern, we're probably going to break below this consolidation. And if that occurs, yes, we're going to break above this resistance in the SLV, and that would propel the SLV up to that 100% extension. My thing is not so much those two, it's just the fact that we're just a little bit above the 10-day moving average. So I'm hoping that we get a little bit of a break here. And one of the questions that comes up all the time in TradeFinder is almost like, all right, we're going to look at one of the metals. And we talked about this in the past, and the viewers tend to pick up on this, that at one time GLD was big brother and SLV was little brother. You know, gold ruled the market, right? And you know that from all your trading, Ducks, but it seems like it's switched a little bit. It seems like silver, you know, we know silver is a main component in electronics, etc. But it seems like it's now silver is the big brother. It's the leader, and gold maybe not so much, but it's hard to know that. But the long-winded story here is I do think that the entries look better on SLV. I just want to wait for a little bit of a pullback here. But you were asking about, I'm going to ask you, what do you thought about Chairman Powell's comments on Wednesday? So they come out with a 25 basis point rate hike. There was a lot of chatter back and forth. Are they going to go 25 basis points? Are they going to go 50? Just 2 weeks ago, before all this banking stuff that we talked about last week occurred, there was an 85% chance in the Fed fund futures they were going 50 basis points. Well, when all that happened, it backed off. 25 was kind of the idea. There was some that thought they might just pause and say, hey, we're just going to wait and look at the data. But they did indeed go 25 basis points. But I didn't like the fact that Chairman Powell came out and said, hey, the markets have this wrong. The fact that banking is probably, with the concerns that have gone out, are going to be tightening their lending standards. That's going to be a restriction on liquidity. And yet at the same time, the Fed has made this new facility, this borrowing facility available to banks where they can come in, which has actually expanded their balance sheet. It's not true QE, you know, it's not quantitative easing per se, but they're making liquidity available for banks to use if they want to. It feels to me, Ducks, like they're talking out of both sides of their mouth, and the market didn't like it. As soon as he made those comments, the market reversed, and we've been churning since then. But we had rallied into those comments. We had rallied to the upside on Tuesday, and then that just, as soon as he said that he thinks the market's got, you know, shouldn't he just worry about? I mean, they're struggling enough to do what they need to be doing in the world of personalities. Usually, when you have an overreaction one direction, you have an overreaction in the other, then things calm down and you kind of churn in the middle somewhere. I feel like they way overreacted to the QE when COVID started, and now they've way overreacted on the rate hikes. I feel like they've put banks in a really difficult spot, and now they're picking on banks. And but yet, after verbally picking on them, they're also giving them a lending facility in the back. It's a mess, Ducks.
Well, listen, Rob, we've got lots of questions coming in here, and I'm really looking forward to getting them. But there's a few stocks we want to go through before we get to that. But one of the questions coming through is a stock you actually wanted to look at as well, which is Block, which is symbol SQ. Had a little bit of a tough week. Let's bring this up to see what it looks like.
Yeah, that's to say the least. That XQ had a rough week. So let's take a look at the symbol. And when you take a look at it, I feel like this was, when you looked at the media, they're like, Block has facilitated fraud. That was the headline, something along those lines. And I thought, that is so unfair to say that, because when you really got into it, what they were saying is that perhaps their security protocols aren't tight enough, and some nefarious characters are using Block, SQ, it used to be Square, to do some negative things, fraudulent things. They're taking advantage of security. I mean, there's hackers everywhere, right? I mean, that seems to be the positive or the big thing, is that the hackers looking for loopholes and holes in security platforms. I just felt like the way it was stated in the media was totally unfair. They made it seem like Block is certainly a proponent of fraud, or they're facilitating fraud. That wasn't what they meant at all. It meant that people have found a way to use Square, Block in fraudulent activities, and so it's the bad guys figured a way in. And you got to think that Jack Dorsey's going to get this fixed, right? I mean, he's not a dumb guy. He's made an awful lot of money in creating the company. So you feel like he's going to get this fixed. But nonetheless, we did have this big move to the downside. We get asked this question, periodically on where we think it's going to go. And so it seems to be a popular one. You said there was a question on it already here, and I can understand that. The positive is that we have found support here. It wasn't a complete washout. It was a pretty rough day, rough week, as you said, but we are well below the 10-day moving average, big gap to the downside, but we're holding its support around 60 here. The most positive thing is that they weather this news, consolidate here around 60, and that at some point maybe find enough of a base to break back to the upside. Now they got a lot of work to do, Block does, because there's all this consolidation here. Here's another one of those triangles that I was just talking about with the SPY. Is you could look at that as a descending triangle, or you could take this line off here and say, no, that was a symmetrical triangle. There's the breakout. And isn't it odd? Again, a news event, Ducks, that propelled this to the downside. I just felt that news event, the way the media portrayed it, was totally unfair, not accurate. And the fact that maybe they do need to patch some security holes in their software, but the company itself is not promoting fraud. They're being victimized, and they made them look like a bad guy when they're one of the victims. And I just thought we should talk about that. I just didn't think that was a fair representation of what really is going on.
We've talked a little bit about NVIDIA over the last couple of weeks. What are you thinking there?
Yeah, I think we need to keep that one on the radar screen, because it's been such a strong performer. And we've had two really good alerts on this for our alert subscribers at ewotrader.com. And you can see this move here to the upside. Now, here's a question for the viewers and those of you watching the recording. I would like to know what your thoughts are on NVIDIA. It's a strong wave 3 to the upside. There's the 10-day moving average. And we had a nice breakout from this little consolidation area here, which we were able to take advantage of. And we had a really good vertical move and vertical trade off of the first move. Then we did an in the money spread, which is a little more conservative for this last move. We are just a little bit overbought. You can see we backed off a little bit, still a little bit above the 10-day moving average, but according to the Ellie wave pattern, we have more highs to go, that NVIDIA could make it all the way to 320. Now the question becomes, do we make a correction to the wave 4 first? And I want all the viewers to know that this is not saying we're in a wave 4. These are projections. What this means is that if the wave 3 is over now, if it's over, there's where you could expect the wave 4 to find support, but it's not stating that the wave 4 is over. If the wave 3 continues up, and sometimes for whatever reason, Elliott wave algorithm is forecasting that NVIDIA is going to make it to 320. Now it could be a sprint up in the wave 3 and it gets to 320 and then we consolidate. So as the wave 3 goes higher, this wave 4 will change, and so will the wave 5, because they're just projections off where we are now. So I'm curious as to what the viewers think on, will NVIDIA continue up now, or is it looking tired and we get to pull back sooner rather than later? So I guess the question is, what do you think on NVIDIA? Is it going to move higher first and then correct, or does it correct first and then move higher? We've taken the more cautious route because, again, we've had some pretty good success with our alerts on it. So I'm in wait and see mode now. You know, the whole Missouri thing, Doug, show me, you know, let's let NVIDIA show us where we're gonna go from here. But I'm just curious what everybody else thinks, because people love this stock. Boy, it's asking TradeFinder all the time. NVIDIA comes up, it seems, every week.
Well, everyone keep those questions coming in. There's lots of comments coming through right now. And one commentator is saying there that I think that there will be a pullback before it goes higher in NVIDIA.
Yeah, I love that. That's what we want to hear, Dux. I want to hear what they think. So
yeah, make sure you click on that subscribe button, people. You can put in as many questions you want. We're doing it every single week. All right, let's move on to your next stock. Stock you wanted to look at was Apple.
Yeah, with Apple, also a you know, really strong stock. And this is also one that we were a little bit cautious on. So we did another in the money debit spread, which is still directionally based, but it gives you a lot more leeway and a lot less risk. And we're at 145, 150. So as long as Apple stays above 150, we're all good there. And you can see where it is. It's closer to 160. Now you might look at this and say, well, wait a minute, that's a 5-wave to the downside pattern. But this wave 4 is at 81%, which means that's disqualified. Once you move above the 78.6% fib level, this pattern becomes disqualified. So the only reason it's still labeled is the software is waiting for the next signal to say, what's the next pattern to come? And I think that's another great thing about Elliott wave. You know, people sometimes will poo-poo it by saying, oh, Elliott wave relabels a lot. That's a benefit. The market's not static. The market's dynamic. The market's ever moving, ever changing. And you better have an indicator that is quick to change with the market. A lot of technical indicators that people utilize are lagging indicators, and it takes a while. It's like turning an aircraft carrier out in the ocean. It takes a while for them to catch up, but Elliott wave's quick, and it will very soon, probably by the time we talk again next week, Dux, this will be relabeled and we will see what the Elliott wave algorithm is forecasting for Apple. But for us right now, it's staying really strong, you know, and it's got more cash than a lot of countries does, right, Tux? And so as long as it stays above 150, we're good. That's where the 50-day moving average is. If it was to break below that level, then we would probably close that position. But as long as it's up there, every day that goes by, time decay is working in our favor. So stay above 150 Apple and we're good. So let's just go ahead and show you what it'll look like. That's what's going to happen when the Elliott wave pattern relabels and comes off. But perhaps there'll be a new 5-wave pattern. And you can see kind of trying to sneak in here, Dux, there's a little bit of a zigzag pattern here. It's a small one, and the upward target when you only have a 38.2% B-wave correction is 61.8. We're almost there. So perhaps we get up to 165 in Apple, and then we need to relook at it and see where we go from here.
Yeah, so one of the comments coming in here is he's going to call it a T triangle pre-move up.
Okay. Fair enough.
All right. I promise we're getting a Q&A. We've got two more stocks we're going to look at here. First one is Amazon.
So taking a look at Amazon, this is in a triangle pattern. We actually have a triangle on this for our alert subscribers. You can see there's the triangle and tried to break to the upside. Now triangles break out one of 3 ways. You get just a nice 45-degree angle move. That's great. Sometimes it'll move vertically up and then come back down, test the breakout, and then go higher. Or sometimes you get a false breakout. We don't know which of the second two scenarios this is yet. You can see we had a pretty big breakout of the triangle, and now we're coming back to test it. So it's still unknown at this point in time if this is just a test of the breakout and then Amazon continues higher, or if that's a false breakout and the big move in Amazon is actually going to be a downside breakout of the triangle. So I think we need to be a little cautious here on Amazon and see where it goes. That's the beauty of having a strangle. You don't care which way it goes. You've got a call and a put. Just let it figure it all out.
All right. And then the last one we're going to look at is our favorite, Tesla.
Yeah, you can't do an event without Tesla, can we? Everybody wants to know that. Unfortunately, Tesla is still in a qualified 5-wave to the downside pattern, and it is trying. I mean, it's really trading right underneath this extremely important level of 200. You can see how that was support back in February. It's resistance now in March, but no doubt, even going back into November, that 200 matters. And so the way I look at this is if Tesla were to be able to get above 200, it's still got a little more resistance here at 220. So I think you kind of wait and see here. I certainly, for me personally, this could be a little bit more of a conservative. Could not look at going long Tesla until it breaks above 220. If it does, though, look at that. I mean, again, there's nothing in the way here, Dux. We're in the clean air again. I don't know if you're a racing fan, but, there's nothing resistance to stop it. So likely if it could break above 220, we're off and running on Tesla, but it hasn't broken above 200 yet. That resistance level has been bumping its head against, and you have to be cautious of this 5-wave to the downside pattern because this is a little scary too. That was a pretty vertical move up. And so if we can't get above and we're trying to sneak down, if we can't get above that 200 level, then Tesla, I know nobody wants to take a, you're really sticking your head out there, aren't you, Dux? When you try to say anything negative about Tesla, there are so many lovers of this stock, they get really angry with you and until you don't know what you're talking about, etc. But we read the charts. We don't trade based on where we think a stock's going to go or whether we like the stock. I think everybody likes the company, and a lot of people have a lot of respect for Elon Musk and what he's doing. I live on the Space Coast, and all these SpaceX launches that he's doing, I can walk out my backyard and it seems like they're going every day now. He's sending so many of those Starlink satellites up into space. But anyway, I do think we need to be a little cautious on Tesla until it can show us that it can get above 220. So that one's a little worrisome there.
All right, let's move into some Q&A. There's so many great questions there tonight. Before we jump into it, don't forget to click on the subscribe button below. We're going to try to get to all of your questions tonight. Also, don't forget, Tuesday nights at 9 p.m. Eastern Standard Time, Rob hosts the TradeFinder show. So if you have any other questions which you don't get a chance to get in tonight, after watching the replay, you can reach him there as well every Tuesday at 9 o'clock Eastern Standard. All right, we're not going to jump in with some stocks here. I've got some really good questions here. One from Ren. He said, what events will cause a wave 5 to the downside to become disqualified? He thinks he's using the terminology correctly.
Well, if it breaks if you have a wave 5 pattern to the downside and you break back above, because remember the wave 4 correction is to the upside in a 5-wave to the downside pattern. So if the wave 4 moves past the 78.6% fib level, technically, now if you read Elliott's works, which is really interesting here, because Elliott was really big on there are rules and there are guidelines. Now, the rule is that if you break above 78.6%, that becomes a disqualified pattern. So if the wave 4 were to go above 78.6, it's disqualified. His guideline was, in his viewpoint, if you got to 70%, it's highly likely that you're going to move up and pass the 78.6% level. So he would give you a little bit of a guideline, like perhaps if you see that, maybe you want to go ahead and exit a little bit early or enter a little bit early, whatever your view is on the direction there. But it's, in reading them, and I'm such a big believer in Elliott Wave, I've read everything that I know to exist that Elliott ever wrote. And it was over 100 years ago, so his writings aren't that easy to find. But if you look hard enough, you can. That's the answer to the question, though.
Okay. And another question from Ozzy. What is considered to be a gap? Is there a specific...
Is Ozzy Osbourne watching? Holy cow, big fan. I'm sorry. I'm
Well,
sorry.
I was going the Aussie option, but it felt a little different. But what is considered to be a gap? And I'd actually like to know the answer to this, because it actually does get asked a lot. Is there a specific percentage separation from the day before that make the gap qualification?
No, and that is a really good question. There's no, it could be a 1% move, but a gap is illustrated here. We just happen to have one in the Tesla chart. So a gap is when you have the high of one day is exceeded by the low of the previous day. So you can see here on the 25th of January, the high there was at 146.41. Well, the next day, the low was at 154. So it leaves a gap here. Now, what causes gaps to get filled, in my opinion, it's a little slightly conspiracy theorist to some people, but I know, doing this for a long time, you've been trading 27 years. I've got a lot of friends that were ex-market makers. Market makers don't want to be directional. When market makers, and their job is to fill trades, like if you want to buy something, their job is to find somebody to sell it to you, and then they keep the piece in the middle. They don't want to be directional. They don't want to have a directional position in anything, but that's part of the deal, is that they find the person on the other side of the trade. And if they're able to do that, then they can charge that commission in the middle. It's almost like the VIG, right? I mean, the 10% VIG, they keep that, and that's what they're looking for. But when you have something like this, for whatever reason, there was interest, and the open of the next day was all the way up at 160. Well, part of what's written in there for that pretty good deal that market makers get, to where, you want to buy something, they find somebody willing to sell, they put the two of you together. They don't have a commitment directionally wise. They get a commission, though. They get paid for putting that together. But if they can't find somebody to take the other side of the trade, they have to take it, and they don't like that. So when you get these gaps, it normally means that the market makers weren't able to find enough people to take the other side of the trade. They're now in a directional position. They don't like it. They want to get out of it, and anything they can do to promote moving back down here so they can get out where they got caught basically in this gap, they'll do so. Gaps get filled. Statistics say, Ducks, we did this, we ran this, 94% of gaps get filled. That's a really high percentage. The only unknown is when. Sometimes gaps get filled initially, sometimes it takes a while. So what the market makers will do, though, when they get caught off sides like this, it's not like, okay, well, they're short the stock and they don't like it going up. They hedge it off. So they're in a position, but they've hedged it off, so they can wait, is my point. They don't care. I mean, if it gets corrected right away, let's go back and look at the chart of the SPY, because that doesn't gap a whole lot. But take a look at this, Ducks, and this is a good example of a gap that gets filled immediately. So we look here, we had the gap to the upside on the 21st. The very next day, the S&P comes down and fills that gap. So, there's two examples there. The SPY got filled immediately. Obviously, the most liquid issue traded in the market is the SPY. And then you got Tesla, which is super liquid too, that hasn't filled yet. But what a good question.
Yeah, no. Now, listen, there's lots of questions up there. The Catalina, I promise we're getting straight to yours after this next question, all right? But the question's coming in from Will. Well, there's so many computer traded, from Charlie, sorry. What is your favorite leading indicator, such as CCI, if you were day trading?
My favorite, and CCI is a good one, by the way, but my favorite one, that's one of our, the way we work at Evo Trader is obviously Elliott Wave is number one. So that's our preferred favorite indicator. If there ever became rules that you can only look at one technical indicator, luckily we don't have to do that. And I don't think it's smart to only look at any one indicator, but I do feel like Elliott Wave is the best, really good analysis of fear and greed, buying and selling, what's going on. Our primary emotions, the two primary emotions are fear and greed, which run the markets. That's the best indicator of that. But if you want to create a good, successful technical trading program, I think you want to have a system, multiple indicators that complement each other. So you get one indicator that has its strengths, but they all have weaknesses. So what's the weakness? Find another indicator that takes advantage of that. The DMI is my favorite indicator. I do like the CCI as well. That's also in our technical trading system, but interesting that they mentioned the CCI. But if I had to pick a favorite to back up Elliott wave. It's the DMI, Directional Movement Index, and it gives you this red line here is an indication of the strength of sellers, selling pressure, if you will. The green line is an indication of buyers, buying strength. And then the black line is the ADX, which gives you the strength of the move. A lot of misconceptions on the ADX, people thinking that, oh, if the ADX is going up, that means the market's going up. If it's going down, it means it's going down. No, it's telling you the strength of the move. So if you're moving to the upside and the ADX is going up, it's telling you that's a strong move. So what's interesting here, isn't it, Dux, is that this downward move here and is concerning, but look what the ADX has done. The ADX has been going down. So it's telling you, even though the S&P has been moving down in this consolidation and whichever triangle you prefer, there's not been a lot of strength to the downward move. There was far more strength to this upward leg that occurred from 380 to almost 420. That was a lot stronger move than down here. So it hasn't been, it doesn't feel good when the market's going down, does it, Dux? But it's telling you that the downward move is a weaker move than that upward move was.
Now, Rob, listen, you make that technology look so easy to use. Is it that easy for everyone to use?
It is. I mean, you just, and the way that I did this, Dux, and what a cool feature of the software is, you can program it. You know, I talk about my favorite indicators, which are Elliott wave, the DMI, CCI, and also like CMF, the chicken money flow. Those indicators create our technical trading system. But as you know, there's a plethora of technical indicators out there. If you have one that you favor, that you like, you can go into the software and program that indicator so that it shows you signals when that indicator triggers, whether it's to the upside or the downside, and you can run tests. And this is what I did when I created my technical trading system, is I would set these criteria up, and it was just, you know, trial and error. Every night before I went to bed, I would set a test, and you can go back a year, 5 years, 10 years, however long you want. And you can create hypothetical scenarios, like suppose I put $1,000 in each trade. And I'm going to get out at X loss, or I'm going to get out at X potential gain. And you can run these scenarios, and the software will run that out for you. So you can see how good your indicator truly is, or your system truly is. And I would do that every single night. And obviously a lot of mornings I'd wake up and say, well, those results weren't any good. Let's tweak something and try it again. And did that over and over and over again until I came up with a system that I had confidence in and believe in. But that's how cool the software is. Anyone can do that. Any indicator, I believe, I'm not aware of any indicator that exists that the software doesn't have. So if you have your own favorite indicator, you can go in and do the same thing I did. Create those tests, see how they work.
And where do they go to find that software, Rob?
HUBB.com is created by HUBB. So people watching this live are subscribers to the HUBB channel. So just go to HUBB.com. Program is called Private Source. You can learn all about it. And they have all these little help things. So if you wanted to go here, you can see that. I right click on Elliott wave. You can come down here, click on that help button. It'll tell you everything about Elliott wave. And same thing with any of these indicators that you want to look at. So yeah, I think it's the best Elliott wave software that exists. I usually say that it's the best one of all the ones that I know to exist, because I've tried them all, because I'm a big believer in Elliott wave. I don't ever want to say I've tried them all. Maybe there's one out there I haven't tried before, but of all the ones I've tried, it's by far the best.
All right, we're going to get into the stocks now. All right, the Catalina. Now, listen, everyone's saying the wine mixer in the chat. It's fine, but there's a fantastic restaurant in Sydney too called the Catalina. But they want to look at Enphase Energy, which is Edward, Nancy, Peter, Howard.
Yeah, this is a common one on TradeFinder too, Dux. A lot of people like this stock. I guess because it's pretty volatile. You can see these bars look okay, not that impressive, but then when you come over here and look at, you know, it's a better than $300 stocks. So these are 30, 40 point intraday moves, which makes it a bit more impressive. You can see that it's been in a qualified 5-wave to the downside pattern, which is it's been following. It did break below 200. It tried to get back above there. And that follow through that I talked about earlier, there was no follow through. It broke above 200 the next day, did not get a new closing high, kind of sideways the next day. And then today we broke back below 200. So it closed there. You can see on this downward move here, though, there was no follow through there either. The next day was to the upside. So you tried to break 200, no follow through. You tried to break back above 200, no follow through. So there's a lot of back and forth. The bulls and bears, the buyers and sellers are really fighting it out right at this 200 level on M phase, or however you pronounce it, N phase. But at this point, if Monday does generate another closing low, I think he can probably look that we're likely going down to this wave 5 target around 160, surely into the 170s. But it has to have that follow through day on Monday. We could easily on Monday close back above 200, and then you're reevaluating again. But it's an interesting stock that a lot of people are watching, and perhaps this is why, because it's really been going back and forth right around that 200 level, but really popular stock.
Let's stick with this energy theme. Ren's asking about Petrobras, one of the most liquid ADRs in the market, PBR.A.
Yeah, PBR.A you want? Okay. Yeah, and this is one I used to trade a lot. Haven't traded it as much lately. And of course, the energy sector was on fire, and not so much lately, as you can see here on this move lower. And if we turn the LA waves, no 5-wave pattern, so we're in corrective mode here. Look at these zigzags. I know we've been, I've been talking a lot, so I won't go through and draw those in an effort to save some time. But those are zigzags to the downside. I think everybody can see them. It looks like we've broken below 9 here, which means pretty likelihood that we're going to come down and test 8, I would think. But this is the range. I think this is the no-go zone. If you're interested in this stock, I would encourage patience, caution. If it can get back above 9 with follow through, then I think you might have something. You're going to go at least to like 1050 with this ton of resistance here. If it could somehow get above that, then you're off to the races. That would be a great trade. So if you could see, I used to do seminars, and there was a girl that spoke fluent Spanish, and she would always pronounce this, and she would pronounce it totally different than I thought it was pronounced. So I'm not going to give it a try. I mean, we'll stay with PBR. But if PBR could get above 1050, you're off to the races here, but that's a long way off. I think you need to be cautious here. Perhaps you could do a short-term upward trade between 9 and 10.5, but beware that that's resistance. And I wouldn't be too concerned about a drop down to 8 there. I think that could very well happen. But if you break 8, one of our expressions that we like to utilize is Katie bar the door, that we talk about on TradeFinder and the insiders meeting, because there's nothing below that. That would be a tough one to imagine. So I think you watch this trading range here between 8 and 9 and go from there.
Sorry, what did you refer to that one as? Katie by the door?
Katie bar the door. Yeah, everybody picks on it. That's a Southern expression. I mean, my family's Southern, so it doesn't seem like anybody else is aware of that. But that's an old expression. It's like, look out below. It comes from an old expression of a barn fire. Katie bar the door. So anyway, keep the horses in, that type of thing. Anyway, a lot of people comment on that expression.
All right. So obviously a lot of stuff happening in the financials this week. We've got a couple of questions in the financials. One from Manuel, who wants to look at NYCB, which is a New York Community Bank Corp.
Yeah, and this is the thing that really worries me. The financial sector, and this is where I think the Fed has to take some responsibility here, is the fact that normally banks borrow on the short end, lend on the long end, and that's how they make money. And that works great when you have a normal yield curve. But when you have an inverted yield curve and you're getting a higher rate on the short end, that's a real difficult environment for banks. And so when the Fed embarks on raising rates so much, so fast, a lot of these banks with the inverted yield curve had to go in to get some yield for themselves on the short end. And then the Fed does this and it catches them off sides. And if there's any sort of a run, like what started the SVB bank run, was they said, hey, they need to raise capital to shore up their balance sheet. That freaked everybody out. Everybody wants their money out. Now the bank has to sell. And if rates have gone up, prices have gone down. So if you hold the bond to maturity, you get the face value. But if you're forced to sell in the meantime, the price could have come down. And that means they're selling all these bonds at a loss so that the depositors can get their money out, and at some point you become insolvent. And that's what happened with SVB and Signature. Now we have Deutsche Bank. But I mean, we've known Deutsche Bank's, been in trouble for a long time. That just seemed to be the headline du jour today. But I just feel like, the Fed is putting some emphasis on the banks when they created this environment for the banks. But looking at this symbol, that's a pretty impressive move back to the upside. This makes me nervous. This was a straight vertical gap up. It's a positive that it was able to get back in here into this 9 area, but I'd be really nervous of this until it can get back above 9. Now that wave 4 has been disqualified. There's another 82%. So on that question of what disqualifies it, that is disqualified. So, maybe we don't go down and make new lows here. But that vertical move with this big gap makes me nervous that we could have some backing and filling on the gap. From a positive standpoint, if you're bullish, you got a good amount of support there at 850 going all the way back to September. If it can get back above 9, then perhaps you run up and test 10. This makes me really nervous to be long here. I couldn't be comfortable being long this without a break above 9 with a follow through higher break above 9. So that one's really interesting looking chart.
Yeah, you must be looking at the questions that are coming through, because you mentioned Deutsche Bank, and Will's asking about Deutsche Bank.
Oh, yeah. Well, even when things were okay, there were concerns about Deutsche Bank. They've been rumored for a long time to be, some pretty questionable practices that they have. But yeah, for whatever reason, they're the ones getting picked on. There was no specific news that came out. It's just like, okay, Credit Suisse was a big one to fall. People knew that, they had done some questionable, riskier things. So you saw what happened with Credit Suisse. They had to get bought out by UBS. And now there's concern that is Deutsche Bank going to be in the same realm that Credit Suisse was? That's what the news was. And so that is one ugly pattern there. And it was trying to have an upward pattern too, right? I mean, we had a pretty strong wave 4 here. We were holding at the important $10 level, which means that all institutions, mutual funds, growth can own the stock, growth and income, anything above $10 a share, even growth and income stocks can own. You get below $10 a share, and it has to be an aggressive investment objective for a mutual fund, et cetera, to own it. So this is nervous time here. It spent a lot of time down in that area, several months, where it looked like, can it get back above it? It was able to do so. And then you get these headlines and it pushes it right back below that. So that's the danger zone. It is a little bit oversold right now, but if it can't find its way back above 10 quickly, I think Deutsche Bank's coming down here to test these lows just above 7. It's just a little oversold right now. But the only thing that saves it from testing those lows, in my opinion, would be a break back above 10 with follow through. That one looks a little spooky to me there.
All right, Lee Chin Lu is looking at LABU, which is the biotech ETF.
That biotech is a play. The drug sector is normally where you want to hide. Biotechs, ever since COVID have been interesting, but this has been when the money started moving back into tech, it seems like it came out of biotechs as one of the areas, because rotation has to occur somewhere. You can see, it's been a while on this wave 5 to the downside. Now the positive here, the Elliott wave pattern has absolutely nailed this. We're right smack in the middle of the tap box. So it looks like we're trying to find some support here. It did for about 2 weeks there, just above 5. If it can hold here and maybe turn back to the upside, but when there's a more risk viewed, you're looking for more McDonald's, Coke. In fact, in TradeFinder, we looked at General Mills. We looked at that last night in Insiders as well. That's kind of where the money rotates when there's a lot of concern and nervousness about the economy and this recession. So I think we got a ways to go before we can see something significant out of the biotech sector. But for right now, this pattern looks awfully close to complete. I don't think you could make a trade based on this. it's wait and see. Again, let it make its next move and let the software, let the Elliott wave algorithm identify where the next impulse move is. So I'd be super cautious on this one too.
Great insight there. Thanks, Rob. Now, listen, having moves like this usually want you to go on vacation. So I'm very interested to see what you're going to think about Airbnb. It's a question from Laurie.
Oh, man. Is it A, B, and B? What the symbol?
Yep, A, B, and B.
You know, that's had just a heck of a run. But look what happened. So, you know, what we've been talking about, Ducks, check this out. Everything we've been talking about, there's your gap up, comes down and gets filled. There's a vertical move with a gap up. So two of the whammies there. So too far away from the 10-day moving average, it gapped up, it came down, it filled the gap. As soon as it filled the gap, it looked like, okay, we filled this gap. Now we want to turn and run again. But it broke below that support at 120, tried to get back above it, and now we're back below it again. But, you know, housing has looked okay. The long end of the yield curve is starting to creep up. Is that going to be a negative for housing? The yield curve is getting a bit better. It's not so inverted as it was. So things look a little better there. So I think maybe real estate and even Airbnb are places that you probably want to be cautious on as well. Now, the positives are it's still in a qualified 5-wave to the upside pattern. It's just unfortunate that it had this huge gap up and it was a vertical move. Those just don't hold. We've talked about that enough, but it is holding the 50-day moving average. But I would be cautious on this as well. Boy, there's a lot of potential risky, positions here that we're getting asked about. I'm glad people are asking these questions so that we can say, hey, urge caution here. It did hold the 50-day moving average barely, but it tapped the 10-day moving average on the high. For me, it's got to get back above 120 with follow through. So this one break above 120 did not have a follow through day, and that's why we came back below it. These examples that they're asking, though, Ducks, have been perfect examples of the concepts we've been covering. What a great session this has been. But for Airbnb, I would be cautious unless it can break back above 120.
Okay, last two, one's from me, but this one is Key Corp, and I haven't looked at this name in years. Have a look at this.
What's the symbol? P Corp?
K-E-Y.
P?
K, as in key, the front door key.
Oh, K-E-Y.
Yeah, that's my accent, sorry.
Yeah, no worries. Funny, when I went overseas, everybody was telling me I had an accent. I go, what are you talking about? You guys are the ones with accents. Yikes. Woo, that's pretty ugly right there. Again, a vertical move lower. The good news is consolidating here. So can it move back up and create that wave 4? It needs to hold above 10. Look where the target is down here around 7. But if it can hold 10, and I don't know if this is, I think this is pretty heavily institutionally owned. They're going to try to support it at 10. And the reason that's so important is that if institutions own it, and I don't remember the exact time frame, it varies, but if a stock trades below 10 for a certain amount of time, those institutions that are not registered as aggressive have to sell. It's a requirement. So what they'll tend to do is come in and buy more to support it, so they don't have to realize the losses in hope that they can create a short covering rally and get the stock back to the upside. I suspect that's probably what's going on here. It's bouncing around here, holding above 10. As long as it does that, it's okay. You do have the potential of maybe it comes up and fills this gap, comes up to this wave 4. If it labels that wave 4, then we still have the potential for a wave 5 lower. But, the positive is as long as it stays above 10, you have some hope here. If it breaks below 10, then there's Katie bar the door again, Ducks. But as long as it can stay above 10.
That comment's coming up in the chat as well, Katie bar the door.
Oh, is that right? Awesome. I think that's great.
All right, one last one. So last weekend, Barron's had their front cover was by the big banks. My own personal opinion, I think it's too early, but can you have a look at XLF for us?
That's probably a really good one to finish on. Let's see what the XLF looks like. But I tend to be with you, Dux. It just doesn't feel like, is Deutsche Bank it? I think we kind of talked about this last week as well. Is this the end of it? It just doesn't feel like, it feels like there's another shoe to drop somewhere. Now, whether it's going to be one of the big banks or another regional bank or whatever, but they're all in the same boat. Now, some maybe have better balance sheets than others, but yeah, I just the positive is it's holding here at a support level 30, and it is oversold. There's a 10-day moving average way up there, and we had this vertical move. I submit to you that at some point, Dux, that's going to get retraced. It doesn't, it's just like a gap. It doesn't mean it has to get immediately retraced, but the vertical moves normally need to. There was a great example on the INDA, the Indian market, a while back that had a vertical move and it traded to the upside for a while and held it. And it seemed like, okay, that's, and then it fell right back down and retraced the vertical move. So perhaps at some point we're looking at the XLF back at 35, but that could be a ways off. I'm with you. I'm encouraged by the fact that it's holding support right here, but I think it's a little too early. It's still oversold, and yeah, I think there's going to be plenty of time to make money to this to the upside once it calms down. I think that it's still way too shaky, and it's nothing more than a feeling that we're going to get another, and perhaps one of these big banks is going to come out that they're in trouble as well. Maybe not with the lending facility that the Fed has made available. Maybe that helps to stem the tide. That would be the most positive scenario that I can see. They're allowing banks to come in and borrow this so they don't have to come out like SVB and Wells Fargo and say, hey, we need to borrow capital to shore up our balance sheet. They can do it in more obscurity. We don't need to know that they're doing it. You know, they're taking advantage of that. Perhaps that does cement the bottom here. But for me, a little too early to try to step in and buy this. But I do think at some point there'll be a good trade here to come up and retrace this vertical move lower. I think we see the XLF at 30. Perhaps if you have a really long-term horizon and you're not adverse to, you know, some risk in the meantime, if you're looking for something to park some money in way down the road, I think that could work out. But I just right now I think is just a touch too early.
Okay, listen, Rob, this has been a fantastic show. And everyone, don't forget, we're going to be back each and every Friday at 5 p.m. Eastern Standard Time. So make sure you tell your friends, tell your family, get your questions ready, lined up from the week, and be ready to go because we'll be here for you. Rob, you have a great weekend.
Thanks. You too, Dux. I agree with you. I think this was a great session and amazing questions. And wow, the way the questions fed right into what we were talking about, it was a lot of fun. And I hope the viewers enjoyed that as much as we enjoyed presenting it. And I hope everybody has a great weekend. Look forward to talking to everybody next week. Yep.
Make sure to come back to watch all of HUBB's content coming through. Everyone else out there, enjoy your weekend as well. Have a good one.
Take care. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today